and welcome to BloombergQuint. We've got a monetary policy review coming up at the end of the week, an important one because there's much anticipation that this time around between the MPC and the Reserve Bank of India, there will be some signals emanating on normalization of policy. What that normalization will look like is a matter of great debate right now. And joining us to talk about some of that is Samiran Chakraborty, Chief India Economist at Citi. He's gone out and put out a call saying that there is a possibility that the RBI may hike the reverse repo rate by 15 basis points. Samiran joins us to explain his thinking. Samiran, lovely to have you here. Thanks for your time.
Thank you, Ira. Thanks for having me.
Samiran, let me start with your call firstly. What prompted you to say that a 15 basis point hike in the reverse repo rate is a possibility at this stage?
So this is just part of an analyst's life that at certain points of time, you have to put out things which you believe the central bank should be doing without having too much concern about whether that will actually be done or not. So this is one of those times where we feel that there are two aspects. One is a fundamental reason, the other is a technical reason because of which small hike in reverse repo makes sense. The fundamental reason is that during the pandemic, there were two emergency measures that were taken. One is that the operative rate was moved to reverse repo. The second is that the repo reverse repo corridor was widened. We believe that the activity variables are telling us that there is no emergency anymore. And the big risk of a third wave being quite devastating, that risk is also lower now, given the vaccine penetration, etc. So if the emergency does not exist, then possibly these two measures needs to be slowly retracted back. And the technical reason is that if RBI has to do 4, 5, 6 trillion rupees of variable rate reverse repo auctions even going forward, then if you have a corridor as wide as 65 basis points, then there is every chance in the successive auctions, the cutoffs come in at very different levels, making the short end of the curve extremely volatile, which is not desirable from a monetary policy perspective. So because of this fundamental reason of reverse repo cut being an emergency measure and the technical reason of a very volatile short end of the curve, we think now it's time to narrow down the corridor and get rid of both these issues. But at the same time, we are arguing that from a cyclical/structural perspective, interest rates still need to be at a very low level for a long period of time. Hopefully, if RBI starts early on taking out the emergency measures, then they have a scope to have a lower for longer repo rate stuck at 4%, along with substantial amount of liquidity in the system.
Samir, I'm going to sort of take parts of that and delve a bit deeper. So, the RBI, yes, cut the reverse repo in an emergency move, widened the corridor. That has now become the effective rate hike. So, hypothetically, if the RBI were to hike the reverse repo rate, would they need to make a distinction between this not being a signal for interest rate hikes and this being a signal for removing emergency accommodation? It's going to take a lot of deft communication because already you've started to see when those variable reverse repo cutoffs came a bit higher, even the long end started to react, right, in anticipation of this being normalization. So how do you think the central bank can balance the need to not tighten financial conditions this early in the cycle, but start normalizing some of the emergency accommodation?
Absolutely, the communication is going to be challenging for sure. In fact, we have written it in our report as well, that that this distinction that I'm making between emergency measure versus the so-called cyclical/structural measures, that distinction often might not be very clear for the markets. But having said that, since the RBI has allowed the VRR cutoff to go as high as 399 in the latest one, the market has practically priced in this 15 basis point reverse repo high. Now, the question is that you can defer it by another policy and do it in December, but that's not going to achieve a lot. The bigger question is what you were saying about how to ensure that this does not transmit into the long end of the curve.
Yes.
I think the short end is still okay for RBI, even if it is reprices 15, 25 basis point, that's probably just fine. And there, I guess the good news for RBI is that the second half borrowing calendar has come out to be a very benign one. So despite our assumption that RBI will probably lower their announcement of the G-SAP purchases, they will have still enough wiggle room to manage the long end just in case the long end starts moving up beyond what their comfort level is. They've found a way of combining the G-SAP with Operation Twist.
Yeah.
And that's how you can ensure that you keep the long end absolutely rock solid at a level where you want it to be. I mean, one can argue whether this should be at 6%, 6.25%, or 650. That's the central bank's choice. But at least the levers that RBI has to control the long end is now more flexible at this moment. Having said that, we have to also understand that there is another issue of bond index inclusion at some point of time that will come and play a role in the long end. So even that can provide some flexibility to the central bank. So I'm not so worried about their signals getting transmitted immediately to the long end and disrupting the market.
What's your thinking, Samiran, on the liquidity side? Now, with the kind of levels of liquidity that we have right now, an organic drawdown will take a long time. Yet it has been pointed out by others that you can't start withdrawing accommodation in terms of liquidity right now. What you can at best do is stop adding. So, one part is GSAP. Do you think it's time to wind down, in one shot or in a staggered fashion GSAPs?
That's what our sense is, that this G-SAP, one essential element of G-SAP is pre-commit. At this moment, I don't think RBI needs to pre-commit a large amount of government bond buying. If the need be, they can always do the standard way. And they've already shown in September that they're matching the G-SAP with an equivalent amount of Operation Twist to ensure that there's no net liquidity addition to the system. But apart from the GSEC side, there is liquidity going to be added from the FX side as well.
Yeah.
Although we think that the second half BOP surplus might be lower than the first half. But till that additional liquidity, RBI needs to start thinking about using it to the forward, to reduce it through the forward market the way they used to do it last year. When the forward points went up, they kind of stopped that route. But now with forward points being more benign, there's a chance that RBI can manage that as well. But the key point for me is that RBI has demonstrated over the last couple of months that even with simple VRR, that too only up to 14-day VRR, it is possible to push the short-end rate all the way up to the repo rate. We don't actually need to suck out liquidity from the system through a cash management bill or a market stabilization scheme bond or an incremental CRR. All those things that we were thinking would be required to push the overnight rate all the way up to the repo rate. It appears to be that it can be done even through the 7-day, 14-day VRR, not even a longer duration VRR of 28 days or 56 days or something like that. So that probably would give RBI some comfort in managing the excess liquidity amount. The only constraint for them would be that the core liquidity is close to 12 trillion rupees now. And the RBI's bond holding, including T-bills, is about 15.8 trillion rupees. So in a sense, the collateral buffer that they have to run these reverse repo operations in the case where the entire government cash surplus gets spent and the reverse repo amount turns out to be exactly 12 trillion rupees, then that buffer that they have is a slim one relative, which could lead to a situation where RBI considers reducing the sort of core liquidity as well. But the other objective of overnight effective rates being close to repo rate, that objective seems to be achieved even without any significant liquidity tightening.
What about the objective of just mispricing of risk in the market? I mean, I know we'll get to CPI in a minute, but there's no easy way to judge whether there's asset price inflation emerging out of the way liquidity conditions are right now. Or even if not that, just mispricing of risk at some parts of the curve is quite possible, or is something that the RBI may fear at some stage.
So there are two parts to it. One part is that the deduced short-end rates because of surplus liquidity, whether it is creating mispricing of risk or not. And the other part is that the surplus liquidity per se, whether it is creating some asset inflation. The first one is still relatively easy to identify.
Yeah.
That you can see where different rated borrowers are borrowing, and you can take a call on whether those real rates for those borrowers are in sync with where they should be or not. But the other point about whether the 10, 11, 12 trillion surplus liquidity itself is causing any asset price inflation or not is a much harder one to predict, because this is a debate that's not just here, it's across the world that central bankers are grappling with. So again, I'll go back to my answer to your last question, that there might not be any urgency on RBI's part to reduce the quantum of liquidity, because this is still an unsettled debate. RBI would definitely want the first part of it, which is to get the short-end rates up to a point where mispricing of risk does not happen from the interest rate side, whereby take the variable reverse repo cutoffs closer to repo at some point of time. But the other issue, they might play along for a while more and then keep this excess liquidity, and it's not easy to get it out also. So that would be my way of looking at it.
Samiran, the point you made about the variable reverse repo cutoff going all the way almost to repo, although it was one auction, that's a really interesting one, because till now the conventional thinking was that, look, they will at least move to say 28-day VRRs, VRRs. Is that still a possibility? I mean, it does make sense, because 7-day, 14 days, very short-term absorption. It's not even really absorption, actually.
So if you go back to the 6th February 2020 RBI's circular on the new liquidity management framework, it's very clearly written there that till 14-day variable reverse repo auctions are for fine-tuning liquidity, and anything more than 14 days is for durable liquidity management. And that kind of ties in with what we were discussing, that if RBI believes that there is no real need to tighten durable liquidity at this moment, they can continue with this 7-day, 14-day also, which has achieved the broad objective of pushing up the short end. But at some point of time, if RBI feels that durable liquidity management needs to be done as well, then yes, a longer duration instrument can also be used. The only catch is that if you are not sure about when you are going to do your reverse repo hikes, and if market is not also clear about it, then markets might not want to lock itself up at a particular reverse repo for a longish duration when it crosses over the next policy. Let's say if you have a more than 60-day variable reverse repo announced on October beginning, which crosses the December policy, people might not participate in it because in December you might have a reverse repo hike. So that way, we have to be careful about sequencing the things. If you have normalized the reverse repo corridor first, and then you do the longer tenor BRR, then there is a higher chance of that BRR being successful.
Samiran, at this stage, what are you factoring in terms of when one moves on the stance? Now I'm talking MPC more than RBI. When one moves on the monetary policy stance, and where down the road do you see repo hikes coming into play?
So at this moment, we have a view that the normalization of the stance to a more neutral stance would be delayed all the way up to April of next year. And then the first rate hike probably somewhere around August of and next year, the repo rate hike. But if you just take a step back and think of what is going to drive this, my sense is that the change in stance, etc., will be a function of how the inflation path behaves at a later stage. While the starting of the normalization process in October, December is more going to be a function of growth and the virus situation. The actual change of stance, etc., will be more a function of inflation. Now, we know that for next few months, inflation is going to be very benign. So if after that, as some of us are expecting that inflation will again go up beyond the 5% mark, then maybe the April change in stance is justified. But if for some reason inflation stays below 5% even then RBI can defer the change in stance even more. In fact, the argument that one of the MPC members has given has some merit in it, that the quicker we do the normalization of the emergency conditions, the longer we can stay on a relatively easier monetary policy path with both the stance as well as with the repo.
No, fair enough. Which allows me to get into growth and inflation. I think at the back of the RBI's mind in making all of this decision is to what extent is the uncertainty on growth reduced. Is one way, Samiran, to look at it by seeing the extent of hit we saw in the second wave. The virus is unpredictable. But in the second wave, when the health shock was significant, the economic shock was still, say, about a third or so, of the first wave. Is that the way to analyze it, that the system is getting more and more used to functioning amid these health uncertainties and health risks?
Absolutely. And on top of it, I would just want to add that just in case we are unlucky and we see a third wave as well, the world over, we are seeing this. The fact that the vaccination rate is improved a lot, particularly in urban centers and all, the economic damage from COVID would be even lower than what it was in the second.
Yeah.
In fact, world over, the shift seems to be from treating this as a pandemic to an endemic situation. And that learning to live with the virus, which was the motto of the second wave, we're going one step ahead of that. So in that sense, I suspect that the growth uncertainty directly from the virus is now much lower. Although I must say that the new growth uncertainty that we have to deal with is the growth uncertainty arising out of China and how it can have a real economic contagion on the rest of the world. That can have second round effects on India. The first round effect is very low. The beta of Chinese growth to Indian growth is extremely low. So, but if it is a generic global slowdown happening on the back of that, then India has to be to some extent careful about that as well.
What's your thinking on sort of the more cyclical aspects of growth, in the sense that, look, this year we will obviously see very high growth rates per se, but the question of what is going to drive growth from here on, will exports sustain as a strong growth driver? Will it be government capex more than anything else, and consumption remaining at the back burner, not back burner, but slightly tepid? Is that the way you're seeing it?
So in an odd way, even FY23, the next year's GDP growth will get distorted because of base effects.
Exactly.
So our view is that next year's GDP growth will be at least 9%. So on top of the 9.5% that we are expecting for FY22, FY23 also will be 9%, simply because the first quarter of FY23 again will be, in our view, almost like a 19% year-over-year growth. So if you have 19% for one quarter, then obviously even if the rest of the quarters are quote unquote normal, you still end up with a very high 9% GDP growth for the full year. But qualitatively, I think what we are hoping for is that middle of next year, we start seeing a private capex recovery. There are a lot of preconditions that are already in place for that. It's the capacity utilization rates, which are still significantly low. So if consumption demand gradually starts improving from here on, then maybe the capacity utilization responds to it. And then by middle of next year, we start seeing that private capex recovery. And as we know that once the private capex recovery starts, you are on practically a virtuous cycle. So So that gives us hope that we should be, even on a structural basis, be closer to a 6% potential growth than a 5%, which some people are worried about. So I think it's still possible to get to that 6%, but the private capex recovery and the virtuous cycle following it would be the most key element to watch.
How important will it be to maintain a reasonably low level of rates by historic standards to keep that capex going? I know there's been a debate many years in the past as to how much interest rates actually do play in. But perhaps, like you said, if they normalize the emergency part and inflation, and I'll just come to inflation in a minute, it doesn't play spoiler, you could have historically a reasonably low level of policy rates for an extended period of time.
Yeah, that's quite possible. In fact, if you look at the weighted average lending rate, that has been in single digit for almost 2.5 years, 3 years now. And we have never had such an extended period of single digit weighted average lending rate. And our view is that from a terminal policy rate perspective, we are looking at something like a 4.5-ish average inflation. And then on top of it, about 50 to 75 basis points of real policy rate, which would give us to about 5.25 on the repo rate as the terminal rate. And then you have to add the term premium on top of it. You take about 100 to 150 basis point term premium, then the long end need not go up significantly to even in the terminal rate environment, which would mean that the overall interest rate structure in the economy can remain supportive for the capex recovery. But I must say that, as you were alluding to, that the role of interest rate that is played on investment, I think the role is critical at the starting point of the cycle. When the cycle gathers pace, then the carrot of growth and return that far exceeds the risks of this and this immaterial 25, 50 basis point of lending rate increases. So it's important that for the ignition of the investment cycle, you keep the interest rates low. But once the cycle has gathered some pace, it's okay for RBI to even consider taking rates up if the need be.
Which brings me to the last question, not because it's the least important, but because it is the tipping point, which is inflation, Samiran. So, lots of different aspects to it. Some people worried that it's been persistent. You may call it supply side, you may call it one-off, you may call it all sorts of things. But the fact is that it's remained high, core has remained high. And perhaps as demand picks up, it fuels some of the demand side, inflation issues over and above the supply side issues. I don't know which side you weigh on.
Look, so there are several parts to this, obviously. So one part is this whole food inflation, which is like half of our inflation basket, which for all practical purposes don't follow any particular pattern. For things like rice, wheat, there's a very large weight on the index. They are in such a surplus state of production that there's no way prices can move up significantly on this, and they're disconnected to global prices as well. If you think of pulses, they used to have a very clear sort of cyclical pattern, but that pattern has also got broken up in the last few years. Then you have the vegetables, which are extremely random. One bad shock, it goes up. Then, as we've seen in the last few months, it did not follow the seasonal pattern of increasing in the summer months. So it's very unpredictable, that part of it. And then you have some odd item like edible oil, which suddenly shoots up some 35, 40% and distorts the entire food inflation picture. So it's very difficult to very nicely summarize this in a demand-supply situation.
Yeah.
There are too many peculiarities to it. So the element where you could have still some demand-supply dynamics is the core inflation part of it, where our sense is that there are two opposing effects playing out. One is, while the demand is improving, the supply side is also improving. In fact, it's a story the world over that the demand is improving, but the supply may not be improving at the same pace as the demand. If that's the story in the Indian context also, then we would be a bit more worried on inflation. But at this moment, the view that we have taken in our forecast is that this demand side and the supply side practically cancels out each other. And that's why our average month-on-month sequential inflation increase forecast is very similar to what a quote-unquote normal year would look like, because of these two opposing effects balancing out. And then the last point is the fuel inflation, where we are working with an oil price assumption of average of about 70 to 75 range. But if we are moving up to 80 plus, then yes, we will also have to relook at the inflation numbers. But broadly speaking, I don't see a reason why RBI would not be able to follow its now declared path of gradually declining inflation every year. 6.2 in FY21, we have a 5.3 in FY22, FY23. Why can't it be below 5? I mean, there is, at this moment, we can always be hopeful that we will be able to get it down below 5. Can we be at 4 anytime soon? I doubt that as well. But if the new mantra is to just get it on a declining path, I think we have enough flexibility on that front.
So then, as one would judge it, only if that path that has been laid down by the RBI, although it's a separate debate whether it's, whether they should be doing that, or the MPC should be doing that, or the monetary policy framework should, formally be doing that. But whatever, if that path is a given, you would only anticipate that they will react to inflation if it is above that glide path that they have mentioned.
Absolutely. I mean, they would be pushed against the wall in acting in a much hastened way, only if the actual inflation turns out to be higher than where that gradually declining path is. But I suspect that at least over the foreseeable future, that risk is not so much there.
All right. Samiran, I'll leave it at that. That's a good place to end. Thanks so much for your time, for explaining your views on all things monetary policy. Thanks for watching Bloomberg.
Thanks, Ira, for having me.